Well, hello and welcome to this special video fund focus with the Blue Whale Growth Fund. I'm Julian Marr, Editorial Director of Portfolio Advisor, and today I'm delighted to be talking to Stephen Yiu, who has managed the fund since its launch 6 years ago in September 2017. Hello, Stephen.
Hello, Julian.
Let's set the scene. What was the thinking behind the launch, as I say, 6 years ago? And an important point, what did you expect to set the fund apart from its peers?
So going back to 2016-17 when we decided to launch the fund, the idea was quite simple, that we want to launch a high conviction portfolio to invest into high quality businesses at an attractive price. And at that time, Peter and I realized that within the marketplace in a global domain that there aren't many high conviction funds. Obviously, you have the likes of Fundsmith and Listen Train Global, that there's not too many. And it is our belief that if we can do enough research or on a very detailed level analyzing a company, that the fund should be able to deliver significant outperformance. So we are trying to probably compete with the passive to suggest that, okay, if you want to pay a fees for the active managers, then at least we would have to offer the potential to outperform the market significantly. So that was the idea behind it.
Excellent. And if I take a very whistle-stop tour through those 6 years, that's going to be a bit brutal, but you can set me straight. I mean, you started solidly, had a cracking couple of years, and then 2022, not such a good year. I know things have turned around again, or bouncing back up again this year. But what happened in those? As I brought it down very simply, but what happened and what's changed?
Yeah, so if we look back 6 years ago, a lot of our opportunities has been centered onto companies that are exposed to digital transformation. Obviously, they would be growing quite quickly throughout that period, and we have some of the very well-known pandemic winners during like 2000 or 2001. Mm-hmm. What had changed last year, which caught us by surprise, was the rapid increases in interest rate expectations in the US, mostly in the first 6 months of last year. And if you look at the valuation of some of these companies at the time, they have been compressed just because there's a one-off valuation reset on high level of interest rate. But when you look at the fundamentals of some of these companies, they are pretty strong. I mean, we still believe that they would be able to recover some of the losses last year. And I think a notable example would be Nvidia, that they have gone down a lot in value last year on the back of interest rate increases. But when you look at the share price recovery recently, they have now surpassed their peak 2 years ago. So they have actually delivered the outperformance that we want them to deliver over time. But yeah, on the back of 2022, it was probably one of those like macro event that wasn't factored in.
But then in that case, so this wasn't we need to change tack here. This was everything's just this is the way that this is part of the way we manage the fund. This is only to be expected. It will come good. There was no panic, clearly.
Correct. I think when we look at the fundamentals of company, this is what we are investing into, is into a company, not the stock market or not just the shares. Is you want to invest in a company that can become bigger over time. They would be able to sell more of their product or services, and they would grow their market share, take more share of our spend or enterprise spend. And some of these companies are actually doing that. So when you look at the longer term return of total shareholder return of a company, it typically reflects the earnings power of a company. Nothing to do with interest rate, but when you look at the shorter time horizon, then of course interest rate would play a role in that.
Okay, great. So that's sticking to your guns into 2023. Things are ticking back up again, as I say, very nicely. Looking ahead now, what parts of the market are interesting you particularly, and why?
So when we reflected on what we did 6 years ago, I mean, that opportunity sets are quite different now going forward. Like there's quite a few names that we used to own a lot, like the FANGs, that we no longer have any exposure to. And we still like some of the technology companies like Microsoft, Adobe, Nvidia that we just talked about. But at the same time, there are new opportunities that come to us that we think they're going to do well, such as like MasterCard or Visa, that we think they're going to benefit from high level of inflation over time. At the same time, reshoring opportunities in the US railroads. And recently, we also added a investment in the energy space, which is something quite new to the fund. But we do think in the next couple of years that the world will remain quite uncertain. So some of these names would actually benefit on the back of the uncertainty.
And just to sum up what are the characteristics again that draw those all together, the common characteristics across them?
So on a very high level, that they are all high quality businesses from based on our research. And secondly, the commonality between all these companies is they're going to take a much bigger market share of our spending in the next 5 years. So if you split the world GDP into different sectors or like companies, we would think these companies would take a bigger share of that pie in the next 5 years, just because even like in the UK, you would have seen that the energy bills have come down this year, but it's still a lot higher than pre-pandemic. When people talk about inflation now, it's still a lot higher than before. So that's a bit of like a regime change. So hence, some of these companies would actually be getting a lot more of our day-to-day spend or enterprise spending in the next couple of years. So they're going to become bigger, or the free cash flow generation from this company would be a lot more certain or a lot higher.
Great stuff, thank you. The flip side of my original question then, are there any areas of the market that you're particularly avoiding, and why would that be?
We do. So on the back of that, one thing that's been quite clear to us was anything that's consumer-facing businesses or sector that we are avoiding, and we try to avoid as much as we can. So whether they are going to be technology company that are consumer-facing, or they're non-technology company, the simple reason behind that is just because our disposable income would remain under pressure on the back of high level of inflation, interest rate, which is a lot of our money are now going to service our mortgages, and at the same time, the reshoring opportunity, or on the back of geopolitics uncertainties, that we're going to produce more goods domestically, which is going to be a lot more expensive than when we used to buy cheap goods from the Far East. So over time, that we just have less money to spend outside of the necessity. So if you let's say if you are a technology company like Amazon, like we might want to make certain purchases, but we're just going to have less money to do that over time.
Thank you. I'm going to move on to valuations here. We've talked about, we mentioned quality, you mentioned tech. Last 10 years or so, that has gone hand in hand with some pretty high valuations. And if you look more closely at the S&P 500 performance this year, break it down, is it almost 2/3 of performance has come from we used to call them FANGs, but now they've got a couple extra, the Magnificent Seven stocks. Would you say the valuations, let's start with them first. How do you see the valuations of those big sort of flag bearers for the sort of the new wave of American stocks? How's the valuations there?
Yeah, this is a very good question. So in terms of the stock market performance this year, in general, I think we share a similar view that the equity market risk premium is too low versus the bond yield or fixed income market. And because of all the geopolitical uncertainty, high level of interest rate, inflation, that we are not positive on equity market in general. But when you're referring to the Magnificent Seven, which we only have 2 stocks, NVIDIA and Microsoft, we don't own the other 5, is we believe the likes of Microsoft and NVIDIA are going to make a lot more money in the next couple of years. Obviously, NVIDIA will be selling many more of their GPUs to power the AI that has been taking shape over the last 6 months or so on the back of ChatGPT. At the same time, you would have heard from Microsoft or Adobe, they're going to launch a tool called Copilot or Firefly, and they're going to charge the users to use those Copilot to automate certain of their tasks, etc. So for them to be able to come up with this new product organically, at the same time charging a higher price, it just means that the company is going to make a lot more money in the next couple of years, despite the uncertainty that we just talked about. But of course, when you look at the other 5 companies, which we do not have a holding in, that we do have some concern. We don't understand why Tesla would have done well. Amazon shouldn't have done that well, but it has done well too. So that might be a bit of like an index tracking in terms of how people think about AI. They would think, oh, every company is going to benefit. But to us, it's only a very selective set of company that's going to benefit which we have in the fund.
Thank you for that. I appreciate this is a far more general question, but then equity valuations more broadly, what would be some points you'd take out of that?
So we feel like going back to the first question you asked, I think it does play into our strength a little bit when we are only investing into, let's say, 25 companies on average.
Sure.
Because like you, in the current regime, you want to be very selective in terms of the company that you invest into. If you ask me now versus 6 years ago, that I feel that our investment opportunity set is a lot smaller compared to 6 years ago. And there's a good reason why that's the case. So if you can be selective, which you need to be, then you should be able to pick some really good companies that are either resilient to the macro regime, or they might be benefiting from this new macro regime. So I think that's quite important to be selective. And of course, when you talk about valuation on a very high level, yeah, we would agree with most commentators that the valuation is not attractive in general. So but when we are talking about the company we have in the fund, we would feel even NVIDIA, the valuation is very attractive, because when you build financial model, you make forecasts in terms of how much money we think NVIDIA is going to deliver in the next 3 to 5 years, that numbers would justify the valuation is trading at today. So you need to be forward-looking rather than backward-looking.
Well, you mentioned forward-looking, and this was going to be my final sort of crystal ball question. I was saying looking ahead on a 5-year view, but let's be symmetrical. Looking ahead on a 6-year view, how do you see the portfolio developing from here?
So one thing that's been quite clear over the previous 6 years is the investment philosophy remain unchanged. The investment process remain unchanged, that we do all the research in-house, we build financial model, we make forecasts, we are very conscious of valuation. But what have changed over the 6 years, and I would believe that in 6 years from today, that would also evolve, is the opportunity set, is what we invest into. There's certain companies that we are investing into now, we think that's going to do quite well, but 6 years ago, we wouldn't have considered them because they're better opportunity at the time. And I'm sure in the next couple of years that we would come out with some new opportunity that we don't have in the fund now, and then 6 years later that we have a very different fund, but they will still be under the same kind of the overriding philosophy and the process, which is the most important.
Absolutely. Well, Stephen, thank you so much for your time. Fascinating to talk to you today.
Thank you, Julian.